What's going on, guys? Let's jump right into the chase. I'm going to cut right to the action and I'm going to look at Nvidia stock. I'm going to show you a new trade that I placed called a poor man's put. I'm not actually sure if this strategy exists or not, but this is a strategy that just opened up on Nvidia, and specifically it is a bearish play. It's actually really interesting, so I want to go over why I opened this strategy up and my thoughts around this strategy. So as you can see right here, I have Nvidia 2 option trade. So I'm going to click into this right now and I'm going to explain to you my logic, my thought process. You don't have to do this on Nvidia if you don't have the same view as me, but why I think this strategy in general does belong in your portfolio. And specifically talking about hedge funds, a lot of people are looking up to hedge funds and they want to understand how to make more money. The thing is, what hedge funds do, the reason why it's called a hedge fund is they're always hedging risk and they're going long and short equities. That is going to make them alpha. Okay, let me dumb it down for a second. Not to say that anyone's dumb, but let me just make it simple. When you go long in equity, you want it to outperform, obviously, and go up. When you go down in equity, you want it to go down, right? So you want to be correct on those things, because if you're not correct, then there's no point of doing them. What I personally did on Nvidia is going higher and higher. It's reaching astronomically higher levels. I know there's a lot of positive news out there, but I am not a buyer of Nvidia. I think it's one of the most overvalued stocks. Agree with me or disagree with me? Here's what I did with Nvidia, okay? So I have a 2 option trade. And this is essentially the reverse of a poor man's covered call. I've covered poor man's covered call on my channel before. A poor man's covered call is when you buy a leap option and then you sell covered calls against that position, basically making a covered call position without having to fork up all this cash up front. Okay, what I did here was actually the reverse. So what I ended up doing was I actually purchased a $600 put. This is an in the money put, okay? That means I think that Nvidia is going to go down. However, I don't necessarily think that Nvidia is going to go below 510 in the short term. This is a fairly big trade, and so far I'm down $1,250. So far it's not planning out, but again, I don't really care about 1 or 2 days returns. I'm very emotionally stable when it comes to trading. I've only been doing this for 10 years. I do not panic or ever get emotional about money. Ever. This is literally the easiest game for me in all areas of life. Me personally, I am down. I'm not scared at all. I'm going to hold this position until February 16. So my goal here is that this put option that I sold actually collected some income. So I sold the 510, collected some income, and that has made my position a little bit cheaper. Not by much, because I've opened up 10 contracts and I've collected like roughly $2.25 or something like that. So I only collected $2,000, but I spent $71,000 on this position. This is absolutely no joke, even for my portfolio, which is at what, like about $1.7 million. By the way, I do withdraw money from my portfolio all the time. That's why it's not going up in value, is because every single month I'm withdrawing money and I'm traveling the world. Right now I'm in Dubai. It is very expensive. This position right here on Nvidia, my goal is that around February 16, which gives me roughly 3 weeks, I'll probably make about $2,000 on this trade because Nvidia will not go to 510, right? So this option will be worthless. The time decay on this option will kick in very, very soon here as it approaches 216. It's already not that far from expiration, and I'm going to end up making $2,000 there. But on an Nvidia put, I actually need it to come down. Okay, so Nvidia might go up and I may lose money in the short term, but what I expect to happen is Nvidia to retrace back to the mean. Specifically, if I open up Yahoo Finance right now, I want to show you the technical analysis on Nvidia. Again, it is pretty difficult to predict the future, and I cannot do that, but for me, it makes a lot of sense to make this shorter term play on Nvidia. And I'm specifically not really using that many buying strategies, but lately I have been looking at using more buying strategies in my portfolio, because the way that I actually grew my wealth was from $7,000 to $70,000. I actually had a 10x return. I was playing a lot of bull call spreads. I was being a little bit risky. Then I had a job. I put in $30,000 into my portfolio, had 100K. I went from 100K to 700K. I had a 7x return. That was trading a lot of Tesla. I had a lot of other tech stocks, and during the COVID times, I actually really outperformed. I did fantastically well, but then again, a lot of people did. However, the next year, I also had a 59% return, and then last year I had a 28% return. So not that high. My returns have been coming down, just being honest and transparent with you guys. However, I am pretty optimistic that I can obviously keep beating the market and doing very well, at least 9 out of 10 years. Okay, so as you can see, Nvidia has ran up a lot, and we also know that's because of like Nancy Pelosi There's a lot of manipulation in the market. Now, if you're looking at the news, I think 99% of the news doesn't make sense, but looking at Nancy Pelosi, yeah, she has really done well. She has, I guess, insider information. There is quite a lot of advantages she has, so I don't really blame a lot of folks trying to copy Nancy Pelosi. It actually makes sense. However, at a certain point, Nvidia does become overvalued, and I just can't imagine this stock being fairly priced from $475 all the way up to roughly $600. You can see here that the RSI is over 81, so this is a hot stock. It's overheating. Yes, the momentum is high, and yes, I have lost a little bit of money doing call credit spreads. This stock basically blew past the Bollinger Band. The Bollinger Band has now expanded because of the, really high, insane volatility, and it's currently above the Bollinger Band. Now, this stock could continue breaking rules and running up because obviously a lot of this movement is event driven, and when events happen, yeah, you really can't stop them. However, this stock basically going up from 475 to 600 is like almost a 40-ish% return or so, if I'm doing the math in my head. So what I think is going to happen is this stock could go up a little bit more in the short term, but in the next 3 to 4 weeks, I'm looking for this stock to retrace back even to $560, $570. I would actually make money on this position. So here's how I'm going to manage the strategy. I am not going to hold until expiration. Typically, I do recommend my students in my Discord community to hold until expiration when you're selling options, but this is not an option selling strategy. This is actually an option buying strategy. And because I have the 600 put, what I want to happen is, honestly, I want Nvidia to go down. Now, I don't need it to go down like tremendously, but I do want it to retrace back to, again, I would like to see it at 560, 570. If I could see 550, I would definitely, absolutely, snapping my fingers, cut the position and take home a lot of profit, okay? Basically, I am looking for a $10 pullback, $20 or $30 pullback, up to $50. So $10 to $50 of a pullback would definitely give me a very high return. And specifically, what I want to look at is the delta right now, because the delta is 0.53. So if this stock goes down by $30, I will make about $15. So $15 times 10 contracts is going to be about, 15 times 10 is 150 times 100 shares. That's $15,000. So my goal here is to make $15,000 in 3 weeks on $70,000, which is roughly a 25% return. So I'm looking for a 25% return in 3 weeks, which is obviously a very high return. This is the poor man's put strategy. So it's basically just buying a put option. And then rather than just buying a put option, I'm subsidizing my costs, making it a little bit cheaper. That's the whole point of a poor man's strategy, is you're making it cheaper on yourself to actually play the position. So in this scenario, it's not that much cheaper, but still it's $2,000, which I consider to be free money. Now, if I was going to explain to you one reason why you should have this type of position in your portfolio, now I'm not saying Nvidia necessarily because, I'm not God. I don't know what's going to happen in the future. I can't predict the market. So obviously you want to learn how to fish for yourself. Why I recommend to have this type of strategy in your portfolio is for a number of reasons. So the market does tend to go up, but having some negative delta or negative exposure to the market is also very important, because essentially you want to bet against the market sometimes. Not with a majority of your money, obviously, but right now I've opened up a 5% position or maybe a 4% position in my portfolio that I am hoping generates me a lot of alpha. I hope that this position generates me an extra 1% this month. Now, yes, I'm betting against the market, but also I have a large exposure to the market in general. So having this type of small position and making an interesting bet like this could really pay off. I'd obviously be really proud of myself and very happy about the results. If it did end up making me about $15,000 in 3 weeks, that'd be a pretty nice chunk of change. It would definitely help me out here in Dubai, as that is pretty easy to spend in just a couple of weeks or less. I have a vlog coming, so if you want to see that vlog, just type in the comment below, vlog. And yeah, I'm gonna have that coming out soon. But I also wanna take a look at not just Nvidia, but I also wanna look at Starbucks, because on Starbucks, this is kind of a similar strategy. I mean, again, this is actually a poor man's covered call. So I mentioned that in the beginning of the video. My first strategy is a poor man's put. Now this is a poor man's covered call. So basically we're really doubling down on becoming a poor man and leveraging our money as much as possible in this video. Nothing wrong with that. I have a good sized portfolio, but I still like the poor man's strategy because you don't have to put up as much money. Who doesn't like some leverage? A lot of people ask me, do you want to use triple leverage funds? I'm like, no, you don't need to, because options are already leveraged. If you know what you're doing, you can have 25% returns in 3 to 4 weeks, just like I'm showing you right now. Starbucks specifically, I'm not up that much at the moment, but I'm pretty happy with it. I'm up $118. And what I did was I bought an 85 call. So this had a delta of, I believe it was around 78. So it was a pretty high delta going out into September. Again, I'm not going to hold this position until expiration. I just don't want to, right? If you hold until expiration, data will start to kick in. And since this is a buying strategy, I would prefer not to be long a whole lot of theta on a buying strategy. Instead, what I did was something very similar. I bought until September 20th, and then I sold some Starbucks 95 calls for March. So this will expire in less than 2 months as I'm making this video. But obviously, if you're watching this video in the future, you can still copy and paste the same logic I'm using. I'm just an option educator. And I want you to understand how I think about these things because I have been doing it for 10 years. This is basically very boring for me. This is just one of my portfolios. I have 3 portfolios and I've scaled option portfolios, over and over again for myself and my students. Honestly, the truth is you want to stick to simple, scalable strategies that are consistent, that are passive. Yes, I don't love buying options. However, I do think there's a place for buying options in your portfolio. Clearly, on this strategy, I'm buying options. I have 10 long calls. This is about a $13,000 position because it's $13 times 10. That's $13,000 that I am long on Starbucks poor man's covered calls. And this is not the first time that I'm doing this. I did this before. So if I go into my history here, actually, let me go into my history of Starbucks because I do want to show you how the poor man's covered call strategy works and how much you can actually make off of it. So rather than me showing you what I'm doing, I want to go even a step further and actually show you my history as well. Now, I'm not really opening buying strategies that much. When I do, I want to have a very high, sky high level of confidence, okay? Because to be honest, I do not like losing money because it's not just my money. People kind of rely on me as well. So I want to make sure that I'm always doing my best to never lose money. Because if you do lose, let's say 10%, you have to make a lot more than 10% to get your money back. For example, if you're down 50%, now you have to go up 100%. You need to double your money to make your money back. That's why for me, I'd always rather focus on consistency, make $300 to $500 a day. Obviously, I'm doing a lot more than that, but let's say I had a smaller portfolio, I'd focus on making $300 to $500 a day and being consistent with that before I would aim for like any big pie in the sky dreams, right? Because I don't really believe in all this get rich quick stuff. I mean, that's why my brand and my personality here just doesn't align with that. So yeah, I would never really recommend someone be too aggressive. Although I have taken risk in my life, in my portfolio, and I've done extremely well. To be honest, the reason why I did that was because I was like 26 years old and I wanted to travel the world. And I was like, well, I'm not going to really get there unless I have a big home run, okay? But again, I took on a pretty sizable amount of risk that I don't know if I would recommend to other folks. I think that for a lot of folks here who have a family, who have a nice job, you really have a good stretch of time, 5 to 10 years. You can become a millionaire in 5 to 10 years. You don't need to do it in 5 to 10 days or 5 to 10 months. You can do it in 5 to 10 years. Yes, I did it in 1 year or 1.5 years, whatever. When I finally realized what I was doing, my first 3 years of trading were absolutely not good. I was following people like Carl Icahn, hedge fund people, whatever they would buy, I would try to buy. Then I was not getting good results. And I realized that that's a really bad strategy, like following Cathie Wood, following really anyone besides Warren Buffett. Warren Buffett and Nancy Pelosi, because yeah, they kind of have like a cheat code. Piggybacking off of them could definitely work. Looking at Starbucks here, back in November, actually, let me take a look here. I have a few different strategies. So October, I had 1800. I think it was actually in early October. I had this 2 option strategy. So this was a buy 80 call, then I sell 95 call. So this was a poor man's covered call here. So yeah, I ended up spending 4,380. Let's see. So I sold a 95, 10, 20, and then I actually bought it back for $6. So I originally sold it for $52, and then I bought it back for 2. Sorry. So there's 3 contracts. So I made like $50 per contract here, which was pretty good. And then I ended up selling another call option because Starbucks had basically gone up to a higher level. So I no longer had to sell the 95 call. So instead I sold the 98 call. I collected $522, and I had to actually buy it back for a bit more. However, I made a lot of money because I did buy this back for $1,300 more, but then I ended up selling my long call option because the long call option has a higher delta. So it ended up benefiting a lot more. So the long call ended up going up by about $3,400. So $3,400 minus $1,300 is $2,100. So it was higher than 50%, but it was around the 50-ish% return from October 2nd to November 8th. So basically 5 weeks, roughly 5 weeks, 50%. It was higher than 50% actually, because I also made money on the one covered call, right? So it ended up expiring and I bought it back. So let's just call it 50%, 5 weeks, that's 10% a week. That's what honestly can happen with the poor man's covered call strategy. Now, keep it in mind, the most important thing before you click off this video, I can see when people click off the video. I'm telling you, this is the most important thing. Do not miss this. This is the most important thing. Managing this strategy and managing your expectations, okay? So the way you manage this strategy, if it's going in your favor, you don't do anything. The first 3 days, you don't do anything no matter what. Whether it goes up or down, you shouldn't do anything. Once you get into a position, the best way to manage it is by understanding that you got into the position for a reason. Your entry was good if you did your homework, if you looked at the technicals, right? Then you want to just hold the position. Nothing should change your mind in the short term. Don't start second guessing yourself. Don't start self-sabotaging. Don't start overthinking. Don't do nothing. Pretend that this doesn't exist. Open this position, give it a few days, then reevaluate it once a week. I do not reevaluate my position over and over again. Instead, I'm looking to go until expiration for my short call option. So here I sold a short call option for October 20th, and I ended up closing it out for, actually the expiration, yeah, it was October 20th, closed it out on October 20th, and opened up another one for November. And then I ended up closing it out 2 weeks later. So again, I didn't do anything for a week, and then the second week I analyzed it and I said, okay, I'm good. I want to take profit here. I made 50%. That was my profit taking point. So I made about 50%, I'm out. I had a good time, made good amount of money. And then I waited for some time, and recently I opened up this Starbucks poor man's covered call again. So here's the takeaways about the poor man's covered call. You want to jump into the strategy with roughly 10 to 20% of your portfolio. Now, if you have $1 million, you're not going to go 10 to 20%. If you have $10,000, then yes, you can go 50% of your money in the poor man's covered call strategy. This is a fantastic strategy for scaling your portfolio. Medium risk. Yes, this is medium risk. However, it has a really high return. So the risk to reward ratio is absolutely amazing. Thanks for watching.